Hi, I'm Dean Mioli, Director of Investment Planning for Citadel Wealth Management. And today I have the pleasure of introducing Gene Goldman, Chief Investment Officer of Citadel Investment Services. Welcome back, Gene, and congratulations on your upcoming birth of your twins.
Thanks, Dean. First of all, thank you so much. I know most people's portfolios are flat to a little bit down. The Goldman portfolio is doubled this year because I'm having twins, so thank you so much.
So, Gene, I always look forward to knowing about your key themes for the investment year. So what are your key themes for 2026?
Sure. My team and I, every year, we develop 3 key themes that we feel will drive the economy and financial markets. So this year, our 3 key themes are, number 1, the economy is slowing, but growth proves to be a little bit stronger than expected. Number 2 is that market returns are going to come in a little bit below the long-term average. And number 3, we will have a market rotation away from those mega cap, large cap technology names into other parts of the market. The economy is definitely slowing down. We feel it. It's been slowing down since post-COVID. We think this year, though, you have a bunch of stimulus coming into the economy, both fiscal stimulus. You look at the big, beautiful bill, for example, that rolled out July of last year with a lot of tax cuts embedded in, but we did not see the IRS lower tax withholding rates. As such, this year, we should see an additional 6 million Americans getting a tax refund, on average increasing by about $500. If you roll this into the economy, assuming a spend rate of around 65 to 70%, you're looking at maybe 0.5% growth to the first half of the year in addition to what was already expected. We also have monetary stimulus. Monetary stimulus is the Fed. The Fed has cut rates by 1.75% over the last 2 years. We expect this year, the Fed may cut rates a little bit more. We'll see what happens given the events, especially in Iran and the inflation events. But overall, the Fed is in a rate cutting cycle that adds stimulus to the economy. Also, if you look at inventory to sales ratios, so inventory divided by sales, these have come down dramatically because last year, companies were so uncertain about the tariff environment, they really pulled in their inventory. They really dragged down their inventory. We think a lot of companies this year will be rebuilding the inventory. And overall, we just think the economy will be a little bit better. The second theme is that market returns will be below long-term average. If you look at the S&P 500, the broad stock market index, over the long term, it's averaged about 9.3%. This year, we have a good economic backdrop. Economy is better than expected, as we expect. Corporate earnings look pretty good, but market valuations are near their historic high. That's limited upside to where market returns could be. So you take this with the uncertainty, especially geopolitical risk, we do think returns are going to be a more modest 4 to 6% return. Third of all, we do expect market rotation away from those big, large cap, mega cap names that drove the market since basically the introduction of ChatGPT in late 2022. We do believe smaller cap names, mid cap names have better valuations, better earnings growth, and historically when the Fed cuts rates, as they've done for the last 2 years, down 1.75%, market breadth tends to widen, small caps and mid caps tend to do well. So we do think markets rotate away from these large mega cap names, the Mag 7, into other parts of the market that are more attractive. So our 3 things: the economy is slowing but proves to be better than expected, market returns will be a little bit below long-term averages, and number 3, market rotation away from mega caps.